Fundamental Voice. Shibani Kurian, the Senior Vice President and Head of Equity Research from Kotak Mutual Fund, is now joining us on the show. Shibani, thanks much and welcome to Markets at Lunch. Let's talk a bit about, the fact that the bond yields have really cooled off. The 10-year yield is at a 2-month low at this point of time on back of course, lower than expected H1 borrowing. Do you expect these levels to remain stable at the current level, or what kind of a move do you expect going forward?
So clearly, the announcement that was made yesterday in terms of the borrowing calendar for the first half was a positive surprise, and the reaction in bond yields has already been seen today. So overall, while the first half, the amount of borrowing that the government has now proposed is lower than what was earlier expected, what we need to see through is for the second half of the year, where clearly the second half is the busy season as far as credit is concerned. If there are any shortfalls on tax collections, especially on the GST front, or there is increase in expenditure and leading to some sort of fiscal slippage, that impact would be felt in the second half. As of now, for the first half of the year, clearly bond yields have stabilized, and the fear that towards the end of the year you would see a significant liquidity crunch, that fear abates for the time being. And if you look at from a sector perspective and in terms of impacts, clearly two things that I would like to talk about. Firstly, on NBFCs, again there was this fear that because of NBFCs being wholesale funded and with liquidity tightening, there would be an increase in the cost of funds impacting margins. Some of that fear in the near term clearly abates, given this kind of move that we've seen on the bond yields front. And in this space, clearly our focus would be on NBFCs, which are expected to grow at a fast pace, especially in terms of their loan book. These would be NBFCs which are operating in segments where competitive intensity is low, especially in the rural and the semi-urban geographies, where growth is clearly on the way back, and the asset quality concerns which had emanated post demonetization, those concerns are now abating. The segment that we are still cautious on is the housing finance segment, where clearly there is a significant amount of competitive intensity and fears of increase in terms of asset quality pressures, especially on the LAP or the developer financing book. For PSU banks, again, it's a short-term relief, especially with respect to the MTM losses that they would have otherwise had to book. But however, structurally things don't really change for PSU banks as a whole. Their balance sheet stress remains elevated. Capital continues to be a concern because now incrementally the amount of NPLs that they would have to recognize goes up post the RBI circular. And also there is a need to bring about structural reforms both in terms of processes, administration, etc. at the PSU banks. So our view on PSU banks remains unchanged despite the bond yields falling, and we continue to remain cautious on this space.
You guess, preempted our couple of questions related to NBFC and PSU banks, because these are two spaces which are more, prone to react to, change in yields. So thank you for answering those questions. Coming to other space, which is oil and gas, and you in your note mentioned that after correction valuations are looking attractive. Which space you are talking about? Are you talking about upstream, downstream companies? What's your view on some of the bigger conglomerates which don't have just one set of business, but they are integrated companies when it comes to oil and gas space? Also, we have seen of late there has been pricing issues when it comes to gas space. How are you viewing overall space, and within oil and gas space, which is the most preferred space?
I'm sorry, I lost you in the middle. Could you repeat that question? Because
Shibani, I'm referring to oil and gas space, and within that space, which is the preferred space within oil and gas?
Okay. So oil and gas as a sector, we've been positive. Clearly on the gas utilities front, we believe that the kind of steps that have been taken to increase gas as a fuel, that will continue given the focus on clean energy. Also, a lot of capacities have already been set up. So incrementally, as utilization improves for these companies, you will see better profitability. On the OMC space, in the near term, there has been two concerns. One related to the increase in oil price, and also with the increase in oil price, fears that most of these OMCs will not be able to pass on price hikes. However, what we have seen in reality on the ground has been that OMCs actually have been taking price hikes after the elections, and that is reflecting in terms of better marketing margins for these OMCs. On the refining front also, structurally we are seeing an improvement and an uptrend, and the overall refining margins remaining fairly stable and steady for the OMCs. So despite the near-term volatility that you have seen in some of these stocks within the sector, valuations look fairly attractive both on an absolute and a relative basis, and OMCs overall continues to be an overweight in our portfolios.
Okay, Shibani, let's leave it at that. Thank you so much for joining us here on ET Now with your outlook on all of those sectors, particularly the banking sector.